Hey guys, it's Stan here. In this week's video, we will talk about the rise of passive asset management. In this video, you will learn what is passive asset management, since when does it exist, and why is it so successful. So let's get started, guys. To understand what passive asset management is, let's first define what asset management is. So an asset manager is someone who manages a portfolio of assets. What are financial assets? Well, we have four types of financial assets. We have stocks, bonds, commodities, and derivatives. Stocks, when you are buying a stock, you are buying a stake in a company. If you are buying an Amazon stock, you are a little part owner of Amazon. Bond, if you are buying a bond, it means you are buying debt of a company. In other terms, for example, if a car manufacturer like Ford issues a new bond, you can buy into the debt, so you're basically lending money to Ford, and they're gonna reward you by paying you back interests. Then you have commodities. Commodities, very simple. Any kind of metal, for example, gold, aluminum, and so on and so on. And gold, by the way, is considered to be the safe haven in the investment world when the markets are very shaky. And then you have derivatives. I made two very specific videos about derivatives, so I don't want to talk too long about it. It's a bit specific, a bit complicated, but to keep it very simple and short, derivatives are tools to reduce financial risk. So when I say manage a portfolio of assets, now that you know the assets, what is a portfolio? Well, a portfolio is kind of a composition of all the four. So imagine I have invested $1,000 and I have decided that as an asset manager, I wanted to have 50% stocks, 30% bonds, 15% commodities, and 15% derivatives. That sums up, of course, to 100% of my portfolio. And this is how basically you manage a portfolio of assets. To know what asset management is and what an asset manager is doing, let's look at the two different categories of asset management. We have active asset management and passive active management. And passive active management, by the way, of course, is the topic of today's video. So of course, we will talk a lot about this side here. But first of all, let's try to understand the differences. Active management is going down historically. Passive management is rising, and let's try to understand why. First of all, what is active active asset management? Well, in this case, it requires frequent buying and selling of assets, which in other terms is also called rebalancing. So you're always buying and selling something. This of course involves a lot of picking, and when we're talking about stocks, it's going to be called stock picking. And what do you need to be a good stock picker and to know which one you have to pick and which one you have to drop? Well, you need to know, you need to do a lot of research, you need a lot of knowledge, and you need a lot of experience. And this has of course evolved over the years. I mean, when you look back over the 70s and 80s, of course there was a lot of reading newspapers and this kind of stuff before the internet. Since now, and when you look at hedge funds and stuff like that today, you will see this is of course highly automized and robotized. Research will take place automatically with a lot of big data coming from politics, finance, economy, and these kind of things. And of course, knowledge and experience is also very helpful. The goal of active management is to outperform the market. That's very important. To give you an example, it's going to be to beat the S&P 500. S&P 500 is the most famous or the default stock index in the world, which represents the stocks of the 500 biggest listed US companies. So here it's clearly we want to beat a standard. On the other side, passive asset management is completely different. First of all, it has been invented by Vanguard. You all know Vanguard probably, especially if you're in the US. It has been invented in 1976, and the first Vanguard passive asset management was called the first Index Investment Trust. Today it still exists, of course, it's kind of like the big product of them. It's called Vanguard 500 Index Fund, and I will explain why in a second. Here on the passive side, you are not actively trading, buying and selling all the time, but it's more like a buy and hold strategy, which has been famous since, well, Warren Buffett talked about it a lot. Basically here you are buying into an index and you are keeping it for a very long time just by reinvesting over time long term. The goal here is not to beat an index or the market, but the goal here is to replicate or to clone the market by rebuilding an index. For example, Vanguard here, Vanguard 500, they are looking at the S&P 500 index, so all the 500 biggest companies in the US, Amazon, Apple, so on and so on, ExxonMobil and telecoms and these kind of things. And they're rebuilding exactly like a clone from it, so meaning they're buying exactly these shares. And the idea is at the end of the year, let's imagine the real S&P 500, so the sum of all the 500 companies went up by 10%, then you would expect that the clone of it, so the Vanguard 500 index fund, for example, is also exactly going up by 10%. The big question, why is passive asset management becoming so popular over the last, let's say, 10 years roughly? Well, actually, there are three reasons for that. Let's look back at what we just discussed and find out the three reasons. First of all, as I just mentioned, in the passive asset management, it was all about replicating the market instead of trying to outperform the market. This is the first thing, and when you look at the long-term analysis all over the internet, you will see that replicating an index, kind of cloning an index, is better long-term, is outperforming long-term compared to trying to beat the market. This is actually pretty simple to understand. Imagine if you're rebuilding the S&P 500 index, so if you're rebuilding exactly what the 500 biggest companies in the US have done, this is a much safer way, long-term, than trying to beat the market. Because what do you have to do if you want to beat the market? Well, first of all, you have to do a lot of stock picking, for example. In other terms, it means at the end, your portfolio, your stock portfolio, you will have less diversification inside, which makes a lot of sense because, I mean, if you're taking the 500 biggest companies and you take all of them, and when you look at how diverse the S&P 500 is, it's going to be difficult to beat this index because, of course, if you are stock picking, you will have a less diversified portfolio. I give you an example, 2020, especially March and April. Of course, you all know the pandemic hit the US, so stocks were going down. But the index in total, the S&P 500, was not crushed so much because everything which worked very badly at that time, March and April, so all the hospitality business, restaurants, Uber, taxis and that kind of stuff, of course these stocks were hammered in March and April and are still hammered, but they were outperformed by the great performances of everything related to technology and online. So here, of course, in a very large index like the S&P 500, you are still performing quite good even in a very big crisis. This, of course, did not happen here because, of course, if you are picking, and let's say you are picking more hotels than you are picking tech companies, well, then you are hugely in trouble here because, of course, if you are picking hotels here, well, you are down much lower. So that's the first thing, diversification, of course, lack of diversification here, and which is, of course, more risky, as I just mentioned, because you have to pick to beat. You know, you have to pick your sides, you have to pick your battles. That's the first point. Second point, and again, I'm talking long term, I'm not talking about outperforming the market for 1 or 2 years, I'm talking about maybe 10 or 20 years. You will see that the strategy, the buy and hold strategy, which has been very popular over the years and very famous because of Warren Buffett, well, they found out that buy and hold, meaning you are buying into an index fund and you keep it for a very long time, well, this is definitely the better strategy than trying to readjust, rebalance, buy and sell all the time. Because what you also have to think about is when you buy and sell all the time, even if the fees are reduced compared to 20 years ago, you still have a lot of fees when you're going back and forth, you know. Another point which is very important here, still a second point, is the stock pickers, so all the research, knowledge and experience in the active management, they are not doing this for free, of course. They will roughly charge you 20% fees. Imagine, like 20%, that's absolutely insane. And that's why a lot of big companies, big investors are moving away from the active management, because what you gained on, let's say, outperforming the market, you are losing it here because of 20% fees. So that's a huge difference, because in the passive asset management, and especially with technology advancing and all that, all the new platforms coming up. For example, I invested in an index fund that costs me 0.02% fees. And then the big rise, or the last reason number 3 why a passive investment is going up crazy, is that a lot of players get involved, especially since the financial crisis. Vanguard invented it way back in the 70s, but it's really BlackRock who made it very popular and affordable and cheap since 2009 actually. So today, when you look at the list of the biggest asset managers, active and passive, in the world, you will see that the biggest companies in the world are BlackRock number 1, Vanguard number 2, and these are also the biggest guys when it comes to passive investment. So that's not a coincidence, you know what I mean? The reason why BlackRock became so popular since 2009 is they invested heavily at the beginning of 2009, right after the crisis. They invested into software and AI and these kind of things in a software called Aladdin. And Aladdin is very famous in the financial world because it was kind of the first very big technology driven software related to financial indexes. That's why BlackRock became so popular, and that's why they could also afford it to make it so cheap, these indexes. Of course, after that, all the other platforms had to follow, because otherwise they would have lost too many market shares. So this is why BlackRock is number 1, Vanguard number 2. So now my question to you, do you invest passively or actively? Do you have an index fund or an ETF or these kind of investments? So let me know in the comment section below. Otherwise, I wanted to tell you that I post once a week every Sunday. So if you like that kind of content, market finance, corporate finance, make sure to like that video, make sure to subscribe to the channel. See you soon, guys. Enjoy your week. See you soon. Bye bye.